All right. So this is, I think, is the first investors panel that we're having. Don't worry, we'll talk about AI, so you're not getting away from that one. When mine got easy, so for those that don't know me, my name is André Thiollier. I'm a partner with Foley and Lardner with a global law firm that obviously focused in tech here in Silicon Valley. I'm American Brazilian, so hence the accent. When Margarese invited me to moderate this panel, I thought to myself, she gave me the easiest job of all the moderators because the amount of experience across all markets that we have here today is incredible. So it's going to be, thank you, Margarese, for the invitation. For those that have been under a rock for 20 years, I'll kind of just ask each panelist to just brief introduction about you and the firm, even though Margarese already mentioned, but especially for the investors, and Ivana, you will have a special introduction for you, but if you can just tell where do you typically focus in terms of size of investment in a company so that we can set the stage so when people are hearing your thoughts, they know where you're investing. So Scott, since you're closest to me, I'll start with you.
Sure. Hi, everybody. Thanks for having us and thanks for doing the panel. My name's Scott Ransenberg. I'm a partner at Riverwood Capital, growth equity firm based here in the U.S., but a global mandate. I sit, I guess, in a somewhat fortunate position of having completed some transactions in Brazil, but today focus more here in the U.S. We are focused on growth, investing right now out of our fourth fund, which is a $1.7 billion fund, and we really try to find companies that I would describe are proven businesses, proven unit economics, but we still see an opportunity to scale. And so we bring that sort of framework to different types of transactions, but are generally writing checks from $30 to $130 million, and we'll do lots of different types of deals. So that's what we do.
Hi everyone, I'm Amy Cheetham. André, thanks for moderating and thanks for having us, Margarese. So I'm a partner at Costanoa Ventures. We're an early stage firm based here in San Francisco, but invest globally at this point. And I lead our fintech practice and also our emerging market practice focused on primarily Brazil and Mexico. And we are investors at seed and A, so write checks from 1 to 8 million across those categories, primarily lead and spend the bulk of our time in B2B software. And for us, that's fintech, SaaS and applied AI, and then data and developer tools.
Hi, my name is Alexandre, Villela, Brazilian. I've been living here in the US for 8 years. I work for a company called Digital Bridge. Digital Bridge is a large specialized investor in digital infrastructure. So we have currently something around $67, $68 billion under management. So we invest in our infrastructure products in data centers, fiber assets, antenna towers, kind of physical assets. And I am the head of the venture capital strategy for the firm. So we typically invest $5 to $50 million per transaction in companies that are Series B or C. Typically, that's our sweet spot. And we invest in what we call infratech, which is when infrastructure meets technology, right? So basically, the software layer that sits on top of the physical infrastructure.
My name is André, Levi. First, thank you, Margarese, for inviting me to join the panel and for André to moderating. I am at DCM Ventures. DCM is a early stage venture capital firm based here in Silicon Valley, but with offices in Shanghai, Beijing, and Tokyo. We invest in seed and A and B. Our check sizes can be from 500,000 all the way to initial check size, the way to 20 million, and we might go up to 50 million in a particular company depending on the fund. We are focused on that depends on the market. So we have an investment thesis for Japan, investment thesis for China, investment thesis for the US, but we do function as a global firm where the investment committee is a global investment committee. I've been there for 17 years. I've seen a lot of transactions, but I'm mostly on the operational side.
Hi, my name is Ivana Ferreira. Thanks, Marguerite for having Nasdaq and me here today. I'm with Nasdaq Stock Exchange. I'm responsible for the listings and capital markets business for Latin America and also Florida. And my job is really to advise the transition from private to public. So I help those entrepreneurs to move and be public in our market.
Okay, thank you, everyone. So my first question is going to be very easy. It's basically what the heck is going on, right? So we just left a global pandemic. We came out of it. We had interest rates in the U.S. as high as we can possibly see in decades. Same thing with inflation. And now we are experiencing two significant geopolitical events, which obviously shifts a lot of things in terms of what the world's expecting for investment decisions and so forth. So to boil down what I mean by what the heck is going on is what do you see, Scott, and I'll start with you again. And again, no particular order. We can jump around as you have comments, please. What do you see the state of investing right now for you, for Riverwood, and the states that you invest in?
Yeah, well, I guess maybe I'll start out with the reality and maybe a little bit more of a cynical view, but end with some optimism. It's been a challenging couple of years, for sure. And if I were to summarize, I think last year was maybe the reset around multiples and valuations. This year has been a reset around operational performance. And at the stage that we play, I think it's for companies that are selling into the enterprise, it's tough. Different categories and different sort of functional areas in the enterprise, it's different. But by and large, this year we've seen most companies, their trajectories flattening a little bit, and difficulty meeting projections, both in our portfolio and in the deals that we're looking at. And I think that, in general, creates a difficult backdrop to do deals. And so, as everyone's aware and everyone is seeing, I think deal volumes are down, and the cost of capital has gone up, and the availability of capital has certainly started to dry up a little bit. So that's kind of on the ground what we're all experiencing and have experienced for the last couple of years. I think the good news that we see is that there, despite all of this, there still are, I'm surprised every day when I come in and I see different opportunities that come into our pipeline of companies that sort of buck the trend and are able to perform through all of this. And so, being an investor in technology and the ecosystems, there's AI today. There'll be something new tomorrow. Sort of a never-ending source of new companies for us to invest in and find opportunities to create value. So I think it's been a tough year for sure. And we didn't even talk about the geopolitical stuff, but I'm still very optimistic, I would say, in general, about the opportunities that we see.
I'm happy to add a little bit more optimism to that as an early stage investor. And look, I think one of the hardest places to be right now is at a growth firm or the CEO of a growth stage company. It's really challenging. And I think at the early stage, particularly seed and A, it's a great time to be an early stage founder. And I think a great time to be an early stage investor because so many really talented employees at these later stage companies have equity that doesn't make any sense anymore. And they don't want to stay there. Not good for late stage companies, but great for early stage VCs. And so that talent market that was so challenging over the last few years where you just couldn't hire people, you couldn't afford to pay them what they were making at those late stage companies, like Nubank, et cetera. And now they're willing to leave. They're willing to take that career risk and start a company. So I think at the seed stage, there's definitely some positivity. It's still challenging. And then I would say the Series A market it is still really hard. And I think in particular in emerging markets, right? Like going out to raise a Series A right now, the bar is really high. I saw some statistic that I hope is not true, that, there were only a handful of Series A's that actually got done this year. And I don't think that's accurate, but there certainly haven't been a lot and it's hard. So I think it's a good, healthy reset generally, but certainly painful and a really hard time to be a founder at any stage.
Well, after you guys responded, I don't know what I'm going to say. I mean, but frankly, I mean, I work in a firm that has different strategies, right? So all of those strategies basically for digital infrastructure, but we have a product for credit, we have products for ventures, traditional infrastructure, performant assets, liquid assets, and we have the benefit of seeing how those asset classes are performing over time. I think this is a great time actually to be in the credit front. I mean, it's being very, very, I wouldn't say easy, but as compared to the other asset classes, it's relatively easy to raise capital if you're, focused on credit. Also, this is a great time to be in secondaries, right? So the secondary industry last year represented something like $250 billion in terms of investments, which is massive. I compare that to, 2010. At the time, the industry was like 10 billion, right? So it is a great, and secondary really thrives when you have industries that are undercapitalized, right? So this is a great moment to be in the curve, I would say, and invest in that sort of asset.
Thank you. So I'll be not as optimistic, but more cautious.
Thank you.
I would say that, today, if you look at the market, you can divide the market into two segments. There is the non-AR market, and then there's the AR market, right? The AI, from a valuation perspective, it's a very frothy environment for the valuations perspective, particularly for early stage companies. It feels like 1998, 1999, and 2000, where anything that had the .ai commanded huge amounts on the valuation side. If you look at the non-AI side of things and you look at the valuation, it has been coming down over the last probably 3 quarters. So if you look at the median valuation today for a Series seed company, it's probably like in the 8 to 9 million to the 10 million. The Series A company, probably a little bit, in the 15, 16 million, something like that. So you've seen that happening over time. And this is a result of multiple compression in the public markets is driving that to come down as well. And the other thing also is that the existing companies today, right? If you see the amount of valuation write down that you see in portfolios today, it's something that you didn't see it, you haven't seen this in a long, long time in terms of a function of how the public markets have been, pulling back on the multiples. 2021 was an abnormal year. You have companies that were being priced at 30 times sales. That's not a number that is reasonable for you to expect from a valuation perspective. If you look at the quality of the founders that you have today, I think that the founders today, they're hungrier and they understand that unit economics matters versus trying to go to the VC and say, hey, I'm going to raise this much capital and I'm going to burn it because I'm going to grow as fast as I can for my next round. That's not the mindset that we're seeing today. They're coming in to discuss what is the unit economics, set the foundation for that unit economic from the outset, and then think about how to grow the business in a, obviously you're still gonna need another round of financing to grow the business, but it's not so much burn the cash today, grow as fast as I can to 12 months from now, go try to raise another round. They're more cautious about the fact that the Series B is a harder round to get done today than it was 2 years ago. So that would be where I would say the market, at least from what I'm standing.
So from my perspective, well, I'm in the public market. So the last 2 years, 22, 23, the IPO market was really challenged to be. We have, real-time valuations being reset. And those are because of the macro factors and also the geopolitical. Came in July, we saw a little bit of a better environment, and which gave us some time for, we brought some great companies to market in September with ARM and Instacart and Clayview. But again, the market received well. They have to take a little bit a step back on the valuation to go public. You saw the type of structures now for companies to access the public market. They also come with some sponsors to make trading. So And then more macro factors again, the end of September, which I think is putting pause on the IPO market. So, but still, we have a very robust pipeline. If you see, we have about 154 filings. Most of the conversations we have now, those companies are saying maybe it will be a 2024 story more than 23. May see a couple of interesting stories at the end of the year. But I think we will see the market open or at least normalizing at better levels in 24.
So let me just double down on what you're saying, because also Alex mentioned about secondaries. So 156 listings you mentioned. Is that what you said?
Filings, yeah.
Filings, sorry.
Yeah, so high quality companies.
Yeah. Listing would be something else. Thank you. 156 filings, and you said that they're all trying to prepare to go 24, 25 maybe, or they will be prepared to do so. Is that accurate data?
Well, it is accurate data that 154 are ready to list. They just a little bit more cautious if they're gonna access the market. So when this is a 40% up of same time last year, so you see companies having been prepared for the last 18 months. It's just waiting for that type of window to list.
And so what does the panel think then about the window that it just opened? Was very curious. We had a brief 1 month window for those exits. Was it a flu? Was it just something related to those particular companies, one? And then two, what is your expectation in terms of public market in the future after we're over this hump, if you will, versus secondary, normal, traditional buyouts?
Yeah, it's a good question and one we think about. I think the truth is, if you look at all of the companies that have gone public, in the 20, 21, 22, and now this year vintage, there really aren't that many of them that are trading above issue, it creates I think a really challenging backdrop from the standpoint of the asset class doesn't really seem to be working for the people that have been investing in it. And so it's difficult. And so, I think it's a hard question to answer as to what's going to be the catalyst for things to open. There are a lot of companies that have been built upon and are even ready to go public. But it's probably not the time right now. I don't have a good answer in terms of a crystal ball and like what's going to change that. But the truth is, for us, when we look at our companies going public, it like the act of going public is just a day, right? Like how you become a successful public company is by executing over a number of years and hitting your numbers and beating your numbers for the next 8, 12, 16 quarters. And so the performance quarter by quarter is not so much important as it is to be able to sustain that over many years. So I don't have a good answer for you, but I know it's a challenging backdrop. So I don't know if anyone else has thoughts.
I'll add one quick thing very quickly, which is just I think it's hard not to be a little bit discouraged when even Klaviyo's not trading all that well and their $500 million of revenue growing 50% year over year, 120% net retention, and burn $15 million getting there. Like, if they're not having an easy time, then man, it doesn't seem very appealing to take your company public if you're anything less than that. And I think that was such a bellwether and such a barometer for how to think about the IPO market going forward. And granted, that one's not trading terribly by comparison, but I don't think it traded the way that people were hoping that it would.
If I can make a comment about the macro environment a little bit, right? So we started to see interest rates here in US going up roughly 18 months ago, right? More recently, and this is really linked to the volatility that we are seeing October, right? The attention, the financial market attention has shifted from I would say, the front end of the curve, interest rates, to the back end of the curve. So in other words, people are expecting this environment with very high interest rates to last longer than anticipated. And that explains why, particularly in October, we saw most of the assets suffering quite a bit, and that's the reason why, one of the reasons I would say, why ARM or Instacart, they are 20% below their the price that they had in the IPO date. When just to compare and contrast against Brazil, if there is one thing that we know in Brazil is how to fight inflation, right? So we are very good at that.
Why?
So Brazil was probably one of the countries that was proactive in terms of increasing interest rates. Or at least how to deal with it. Yeah, well, that's a fair point. So what is interesting right now in Brazil is that we are starting to see the central bank in Brazil easing the fiscal policy, which means that interest rates are going down. And at the same time, we are starting to see, kind of the fiscal condition in Brazil worsening a little bit. So governments are spending much more than they expected to spend, and we started to run some deficits. When I combine those two things, right, what is happening here in the US and what is happening in Brazil, my conclusion is, I think, first of all, we are going to see a devaluation of the currency in Brazil in the last year. Second thing, I think that when it comes to VC environment, the VC activities obviously is inversely proportional to interest rates. So for instance, in our credit products at Digital Bridge, we are getting returns that are kind of mid-teens, which for credit, which is, very low risk type of asset class, is kind of fantastic. 2 years ago, that would be impossible, right? So I imagine that this slowdown that we're experiencing in the VC industry is going to last maybe 12, maybe 18 months, right? So, and of course, the founders, they have to be prepared for an environment where liquidity is going to be strict, at least during this time.
I'll just pick up on a point that Scott mentioned. For a functioning window or IPO window to be in place, you do need to have the trading price to be holding at least above the IPO over the long term. You expect some volatility in the first 6 months because you're on the lockup. There's not enough float out there for the stock. It's going to be restricted in the hands of the IPO buyers with a small piece trading. But after that 6 months, that's when, at least from the chair that I sit, I start looking at our portfolio companies that have gone public. What is happening to that particular stock? And again, in order to have that function IPO, the trading price needs to be above the IPO. Now, one thing that, your point, like it's one day in the life of the public company, of the company. But the work that goes to get that company to have a float that is increased and allow the VC to exit is tremendous, right? If the company doesn't have enough volume, the VCs are going to be stuck holding that position for a long, long time, not being able to do it. If you sit on the board, you're even worse because then you have blackout windows and things like that. So all of these elements function to create the situation. Are you going to have a functioning IPO market or not? I think the most important aspect is, and this is what we tell the entrepreneurs, is that focus on the business, focus on the fundamentals, make sure that the company is still growing. Try to make sure that your employees are not impacted by the fact that, they're now going to feel less wealthy, if you will, because of the movement in the stock price. So the mindset is just to really incentivize the entrepreneurs to focus on creating the fundamentals for the business to support any sort of growth that will come in the stock price.
So again, to pull the thread a little bit on what to tell entrepreneurs and see what the market's going to look like 18, 24 months from now. I like the fact that at least the first three mentioned, it's all great and dandy. It's all going to be, I'm obviously exaggerating. And then Alex was like, well, interest rates are going to stay up for another 24 months. So which one is it? So what are you, and it will be interesting to hear at different stages. So André just mentioned something about what sounds like, André, what you're telling your portfolio companies to focus on the business. Is this across the board? And I think, Alex, you're in a particular place because it's a very unique, specific industry. Amy, you're early stage, and Scott, your growth and late stage, but more broad and more agnostic industry. Is that the same kind of advice that you're giving to portfolio companies on your calls?
Well, I mean, for us, I think the philosophy around what we tell our companies it's been very stable, in the 15 years since we started the firm. It's focused on unit economics. Now, I think the interest rate environment has changed. The cost of capital has changed. And so the threshold through which you would classify something as compelling and interesting unit economics might change. But being focused on understanding what your unit economics are, where you're investing incremental dollars and what the returns are on those incremental dollars are kind of like, we're focused on growing the businesses and growth being the source of returns. And so you have to understand where you're investing and what's working and what's not, and how to pull levers if that return threshold changes. So it's always been the same philosophy for us, and maybe the return hurdles change a little bit, but philosophically, it's always been the same.
Yeah, I say similar for us where, at the early stage, the hypotheses that I think about that you need to prove out at each stage have stayed pretty similar, but I think we got a little confused about them as an industry over the last few years. Our philosophy has always been like pre-seed is like, is this a good idea? Seed is, will someone buy it? And Series A is, will a lot of people buy it? And those are the things you're trying to prove. And I think we got confused and we sort of forgot that by Series A, you should actually be able to sell the product, and investing more money into that company directly translates to revenue. And I think that risk reward trade-off between seed and A kind of got blurry and people got confused. And so I think it's going to be much harder to raise rounds at the early stage for the next few years, because going back to Scott's point, like people are going to be way more focused on unit economics, on, hey, if I give you $10 million, how's that going to translate more directly into revenue? And I think that's a good thing from the standpoint of building much more sustainable businesses that will probably perform much better as public companies in the future. But it makes it really hard because we've been in this world for the last 3 to 5 years where most people that raise seeds were able to raise Series A's. And so it is really scary to be staring down the barrel of like, that's probably not going to be the case going forward. And that's a big change. So I think the advice to entrepreneurs is sort of, hey, this is a changing environment. You've got to be able to navigate it. And two, like, this is really hard, right? Like, I think we were all sort of laughing at the video of the CEO of NVIDIA a couple of weeks ago that said he wouldn't build a company right now if he had the choice. Like, he's the founder of the most valuable company on earth, and he doesn't want to do it again. And it's a really hard job. And so I think our job as early stage investors is to try to help people navigate this really challenging environment.
Just to stay with you a little bit more, are you seeing way fewer deals? Because there is a sense of, okay, the late stage and growth deals that has reduced, but because of the risk profile of early stage investment, maybe that is not the case. Does it impact your business a lot, or are you still seeing the same kind of deal flow, but not with the same frenzy that you saw in 21?
Probably
and
not.
Alex, you'll be ready because you're next for my first question.
I think not at seed. Maybe a little bit from sort of the hype cycle we saw in 2021 and early 2022, but there's a lot of really interesting seed stage deals out there. Series A, a lot fewer people are going to market. They know it's really hard, and so that feels like the category where way fewer companies are coming to market. I think that'll probably change next year would be my guess, but at seed, I feel really excited about the quality and the number of opportunities that we're seeing.
Yeah, perhaps one piece of advice that we always encourage our entrepreneurs is, I mean, in a very high level, at the highest level, we always can divide, the startups in two groups, right? The startups that are selling painkillers, which means mission-critical products, right? Products that are very essential, and startups that are selling vitamins, right? And there is no question you can build awesome business selling painkillers or vitamins, right? But we are in a particular moment in time that the appetite for vitamins is certainly not what it was 3 years ago, right? So one of the things that we really encourage our entrepreneurs to do is kind of, have a very critical review of the product portfolio and really focus on items, in particular for enterprise sales, right? So really focus on ROI, return on investment. The value proposition has to be very crispy, very easy to understand to customers, and has to be tied to a very, easy to understand metric on how the customer that's buying that particular product can benefit from a cost reduction or revenue increase, right? So this is, I think, is very, very important. And of course, I mean, as I mentioned before, Digital Bridge has exposure to infrastructure assets. You know, broadly speaking, leverage, right, has been a pretty important lever for, you know, capital gains. So companies, they really engineer the capital structure in a way that, you know, you have a lot of that in your balance sheet in a way to boost returns. And of course, a piece of advice that we are sharing with entrepreneurs, and we have been doing this for the last 18 months, is basically to, you know, try to have a more conservative capital structure, because this is the time. This is not a time to be over leveraged.
So I'll now pull the curtain of AI, and I'll combine two questions that I had. In terms of sectors, and André, I'd like to get your perspective also with investments made in Asia as well as compared to the US. That would be great. So what are you looking for, and what are you seeing in terms of AI trends? And you made the comparison between valuations, but just the solutions themselves and teams and so forth, and the verticals that you would like to invest in, type of investments that you're making. And that goes for all the panelists.
Yeah, I mean, we're looking at AI, making a comparison to internet.com era, right? So we're focused on the application layer. That's what we're focusing on. We're not focusing on the models, the LLMs, or anything like that. We're focusing on what is the application that can be built upon this. Now, in the US, you have great LLMs. In China, you don't, right? Baidu has one, but is restricted. There's censorship. There's all these different things. And frankly, the rules there are not so clear for you to be really going full-blown on the AI over there. Japan is a bit more interesting. A lot of the stuff happening in Japan uses some technology from the US, but also some native there. But the market in Japan is mostly B2B, not so much on the B2C side. So our focus has been look at these application layers and see the team of founders that are able to execute on this. What is the problem that they're trying to solve? And we're trying to look at areas that are not sexy, areas that are not really, you know, mainstream, that people are just going to go. Like, for instance, I use the example of a company that we have in the portfolio that they develop a tool to focus on personal injury attorneys, right? The largest class of lawyers in the US. You know, if anybody, just to give you a little preview here, most of the cases get settled before they actually go to court. And in order to get settled, there needs to be a demand letter that is written that has things that are listed over there. So this company created this tool that is able to help the attorneys to draft the demand letter. It gets information about the settlements. And so the network effect in terms of the database that they're building has just exploded. And they become the company that our personal injury attorneys are going to in order to get that information and to use that. Very unsexy business. Nobody has ever thought about, oh, let's focus on the personal injury attorneys as a you know, a target market, right? But it is a huge, huge business.
All I heard was that lawyers are driving the economy, but anyway. Alex, Amy, or Scott?
Yeah. Well, very complimentary to André, because André is the application guy, I'm the plumbing guy, digital infrastructure. So things that we are seeing that I think are very, very interesting. So first, we see a massive monster category here emerging here in the US, which is, people call that GPU as a service, right? So you can imagine AWS for artificial intelligence. So basically, you know, companies that are building computing capabilities to train models, and the demand for that is really, really high, right? So I think the best public example, and is one of our portfolio companies through one of our strategies, is a company called CoreWeave. So the numbers are, you know, public, so I can comment. So CoreWeave last year, they made $25 million in revenues. This year, they are gonna cross 500 million. So it's like a 20x, you know, increase. So which is kind of awesome. So GPU as a service is a massive category. We see other companies. I could mention Crusoe. I could mention other companies that are in the same space. Hive is another example. Well, this is one area which I think is super, super interesting. We also, I mean, we have the same understanding that today every CEO, every CIO has been challenged by by their board to have some sort of strategy for generative AI. So that becomes a hot topic for everybody, right? So one area that I think is super, super interesting, and of course our angle is always on the infrastructure side, but we see, applications like, knowledge discovery, which is in a very high level is like having your chat GPT in-house for an enterprise application that is able to use your proprietary information and provide, human language answers to people asking business questions. I think this is kind of universal use case. We are super bullish about use cases around that. And finally, when it comes to AI, we also think that there is a huge market for AI-powered infrastructure management applications, right? This is another area where we are going to see a lot of actions in the coming years.
I'll just add maybe two quick anecdotes. And first of all, Scott, maybe you should find out about that company he was just talking about. But second, I think I would echo Andre's point around this being a really interesting catalyzing sea change, right? We saw the internet and then cloud probably as the next analogous change. And then I think this is the next one, but I really think we're just scratching the surface. And our strategy has actually been maybe the opposite of yours, Andre, which is going after the infrastructure and understanding how do you build these applications on top of that infrastructure inside of so many of these organizations. And the one anecdote that I'll share really briefly that I thought was fascinating was that we were chatting with the CIO at Stripe, and they built an internal tool to access internal information. And 75% of the company uses that tool on a daily basis now. And this is an LLM they've built to access internal information. And I was fascinated by that, how quickly these tools are growing inside these organizations. And so we're excited about building the tooling. We're, of course, excited about investing in the app layer as well. But I think we're so early on the app layer side that we don't really have a total understanding of exactly what kind of impact that's going to have inside of organizations yet.
Yeah, I guess the thing that I'll add is I don't think we encounter a company today where AI isn't some part of their speech. Part of our diligence process and getting to know the company is trying to validate how real that is, obviously. But it's pretty much a part of every single company's pitch. And as I look at our companies that didn't necessarily start out as AI businesses, every single one of them has tried to incorporate it into their business. We're trying to incorporate it into our business, making our people more efficient, making our product more efficient, and ultimately rethinking our products. And so, that's just a part of everything. We haven't been really looking at investing in the core, sort of components of AI just because it doesn't really fit with our underwriting framework. But it very much bleeds into every single company we look at.
Before we go to Q&A, because I know we're running out of time, I could stay here asking questions for 3 days. Ivana, is there any data on the number of companies that have filed that claim that they are AI based?
Well, I think, from looking at the pipe, I think 50% of them are defined as a tech. And within this tech, we know there is a, strong or some type of AI enable. And then you break down with some consumer that also will incorporate some AI, and then followed by some energy sustainable. That's where we see the universe of our, companies that are leading to list.
Thank you. So we'll open for Q&A from the audience. Any questions? And there will be, I think, a mic that will be passed around. If you do, please raise your hand.
Yes, Harold. Your
Name and company. Been doing this for a bit.
Hi, Harold Batista, board member here of BayBrazil. And this question is actually to André. What's your view on China? Where's it going? Is it going down, going sideways, up?
Thank you so much for putting me on the spot, Harold. I appreciate it.
How much time do you have?
Yeah, thank you. Well, I think that, today, you're talking about just China standalone, or you're talking about the U.S.-China relationship? Okay. So one number that I share with you about China, 1.4 billion. 1.4 billion people still live there. So it's a massive market. From an opportunity perspective, still very much a very attractive opportunity. What you have to figure out with regards to China is that, just like Brazil is not, China is a very complex environment, very rich in culture and also in terms of how you do business culturally over there. You have a situation today, not to get political, but just to, from a framework, is that you do have a situation that was unprecedented when the whole, capitalist movement in China started, and I put in quotes, is that before it was very defined that if you were the shepherd of China, you were there for 2 terms and then you cede power to the next. That's not what we have today. So today we have somebody that has been able to extend to a 3rd term, and who knows if he's going to be able to extend to a 4th term. And so when you look at that, it gives you pause in terms of, are the rules of the game are still going to be visible for you to understand? And then to complement on that is that what is going to happen to the exit side of it? From a VC perspective, I go into a deal, but I'm automatically already thinking about what is my exit going to be. And it's very cloudy right now. I think that, we've been able to get 2 companies public in the US over the last 12 months. It was not an easy task. Hong Kong seems to be a more viable option today from an exit perspective. But I think that, you have a pretty large market. The economy is not growing as much as was growing before. There is a situation with the real estate sector that has a significant impact in terms of the economy, and we need to see how that's going to play out. I don't think we've seen the real estate crisis fully play out yet. I think that's still developing. So I would say that in the next 12 to 24 months we're cautiously still optimistic, but very, very careful about the type of investments that we're making there.
Any other questions?
Zuka Palladino with Woki. This is probably for Amy, thinking fintech and naturally kind of everything that's going on with Israel. I don't know if anyone else has investments there. Been talking to a lot of founders in fintech, and naturally there's a very important aspect of crisis management going on, specifically a lot of people being called to duty, some casualties. How are you dealing with crisis management at this stage? Any insights on that, if any?
Yeah, I mean, first of all, it's obviously a terrible situation. And I think we've been relatively lucky that our portfolio doesn't have a huge concentration of people in Israel. As you know, of course, there's lots of, in particular, fintech companies and security companies that do have large teams there. I will say one of the downstream impacts that we've had is that many of our portfolio companies' customers have people there. And so figuring out how to be supportive of their customers, but also knowing that that's probably going to have an impact on pipeline and revenue as a result, right? And, a lot of these teams are so focused on relocating people, trying to figure out how to deal with the number of people that have been called to duty, that it's really challenging. But I'd say, personally at Costanoa, we haven't been super impacted, though I've heard from other firms that it's been a really big challenge.
Yeah, we have one business that's headquartered there, a couple of companies that have some operations. We've got a bunch of companies in our pipeline that are headquartered in Israel. So here's what I guess I'll say, and I can say the same thing about it's not completely related, but the anecdote and parallel I'll draw is around, I'm surprised, I guess, or maybe not surprised, but impressed with companies around the world and their ability to handle crisis. When we had interest rates and inflation for the first time, like changing last year in the US, companies really didn't know how to respond, how to react. And we looked at a lot of companies in Latin America, and they had already made changes. They were already doing things that they're just making changes. And so what I've observed is, for better or for worse, companies that are operating in jurisdictions and regions where there's been conflict in the past, they know how to deal with it. That doesn't diminish from the situation. It doesn't make it easier, but at least to date, we've observed companies managing it.
Into that?
Just from a listing perspective, we did some companies in the pipeline that, of course, they delay now for end of next year.
I think that's all the time we got. I want to thank the panelists for this insightful chat. Thank you, Margarita and BayBrazil, again for having us. Thank you.